Welcome to Thursday. We're the derivative desperados, the risk wranglers. Today, we have a monster sell-off in the markets, and our topic is the inverse VIX short-term futures ETNs. So let's get busy after the bell. No Yellowstone music, so we got that going for us.
Oh, okay.
I found this. I finally found one of my cowboy hats. God, I always look crooked.
Right. These things. So, Lex, this is for you, buddy.
Yeah. What? Get out of here!
Wow.
Mark, get on the boat.
I'm feeling left out. Oh, I don't have that kind of surprise.
There you go. Still have not seen one show of the Yellowstone.
I love it. I love it.
Yes. I can't decide. Someone types in the chat here. Which name do you like for the show? Derivative Desperados or Risk Wranglers? Some of the ones we had before we were taken already. So we want to kind of change it up a little bit. So if you're bold enough to type it into the chat, let us know which one you like better. That would help us. Don't forget to subscribe to all this stuff. Hub.Tradier.com as well. Summit coming up next Wednesday, the 9th, at 10:30 a.m. Eastern. We'll talk more about that at the end. Let's get busy. So monster sell-off on today, Liberation Day, the tariffs. We're going to talk about it all. We're going to morph into talking about these tariffs, what they could mean. And we're also going to talk about this short-term VIX inverse, right? I think, Mark, I'm going to call you the expert on this because I know I am not. So the ticker is VYLD, Victor Yellow Lima Delta. What's the Y, by the way? Hold on, I'll look it up. Yankee. Got it. So let's get started there first, and we'll take a peek at the markets. Mark, you want to lead us into this, or what do you think?
I mean, what better day to talk about short vol than a day when the VIX is up 20%?
Yeah. Can you? I mean, this is we kind of knew this was going to happen anyway. That this was an easy one, I think, at least the short-term version of it, with the tariff announcements.
Mm-hmm. For sure. Although it is interesting how much the vol is really reacting today. Like Liberation Day was yesterday. We should have this was very well telegraphed. This is like the earnings announcement that you get the bad news and you sell after the news. Yeah. Even though it was very clearly kind of written on the wall.
So what did VIX do yesterday, knowing that today was Liberation Day? Did you follow that?
I believe VIX was pretty flat yesterday.
It was over VIXed for what it was, but not by a lot. That being said, though, we did see, in VYLD we saw spreads very, very wide. So dealers were ready for this. Yeah. Customers were also ready for this because there were a lot of puts that were bought, and now they're all in the money. So we'll see what happens, because when all the puts are in the money, you just need somebody to buy, and you can get a rip. So,
having said that, then
if no one's buying today,
not today.
Listen, look what happened yesterday. It was a springboard bounce back. I'll take up on the day for the right ratio.
Up on the day?
Yeah, up on the day, and we'll pick the spoons, the S&Ps.
A friend to you and me did the same thing the other day. We were watching the NCAA tournament, and a friend is Henry. And we were sitting there, and he was enamored with these, like the pick'em kind of ratio basketball games, right? And it was like Gonzaga versus somebody else, and Gonzaga was losing by like 20 points at halftime, and he was enamored by betting the 4 cents on Gonzaga to come back and win because they're Gonzaga,
right?
And I was like, if you want, you can just give me $4. Like if that's the
until you're wrong, like yesterday. This is a big one. Will take a lot of odds in my favor to bet this one.
Yeah, you would have like you want to bet you $2.
Right. What'd you say, Mark?
I was just saying I'm pulling up the option that would be green on the day. So
yeah,
SPX is down 220. That makes green on the day like 56.70.
Yeah.
Want to guess the delta of that and the price?
So we'd probably be higher.
Expiring today.
Expiring today in
I'd
5.5 hours.
I'd say it's, geez, the delta. I'd say, God, wow, 2.5.
I'd say delta, something like that, like 1. But it's not.
Let's start there first. What is it?
It's not even a 1 delta. According to TradeHawk, it's a 0.9 delta.
Yeah. Okay. It's almost a 1. So 2.5.
So it's almost a 1 delta, and it's trading at 30 cents.
No bid.
A quarter bid.
25, 30. Yeah.
That's aggressive quarter bid. So you're saying there's a chance?
Yeah.
Amazing. Okay.
But I bet is it like a quarter bid for 56.65?
No, that was 30-cent bid. So it actually, there is price granularity at that. It's not like the flat part of the price. That's
wow.
Yeah.
All right. Mark, tell us about VYLD. So it's an inverse VIX short-term future. What the heck does that mean? So obviously we know what inverse means, but let's just explain it out a little bit. Tell us, if VIX does this, what is this VYLD supposed to do? And incidentally, sorry, it is a note issued by JPMorgan Chase financial company, right? So, always the risk is if that goes belly up, that's always a risk. But, all things being equal, that's probably not a massive risk, I'd say here in this case.
Yeah, I mean, all these ETNs are issued in the same type of way, and all the short vol products have the same structure. So it can get squirrely, of course, like if something happens, that was discussion in 2008 and even with volmageddon. But yeah, for the most part, if this behaves the way it's going to behave, you heard me earlier in the show say VIX is up 20% today. Really like to talk about the VIXs moving different percentages or whatnot, because it's a volatility number, and a percentage number on a volatility number isn't totally fair. But what standard short ETN products try to do is they mimic the moves of the VIX on a day-over-day basis. So if that goes up 20%, your short, ETN, short-term VIX replicator ETN, you would be down 20% or 22% right now. What's different about this VYLD is that it treats the moves in VIX as your points into percentages. So the VIX is up 6 points today, meaning implied variance at 30 days has gone from 21 to 27. And that ETN would be down 6% today. Mm-hmm. So it changes the texture of the way VIX moves are applied to a short volatility position.
Okay, who's using this product? It sounds like it's very retail centric, because you could do the opposite with selling VIX things, or buying puts and blah, 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 right? So it sounds like it's very retail centric sort of product.
For sure. These are very retail centric products, and they're also generally like day traded products, because part of the structure of the carry of them can be, they're trading a lot. And so they're rebalancing, and they're intended to mimic the 1 day moves usually in the market. So not over a continued basis, but with any short vol strategy, right, the big risk is that you can move 100%. Like the VIX can go from 15 to 30 in a given day. And then what happens if you're short?
Right. So, but this is taking the inverse of VIX. So if VIX is up very big today, you said should this replicate exactly, or not exactly, but close to the upward move in VIX as a downward move? Is that right?
Correct. So VYLD is going to be down today. It should be down about $6.
Why is it not? Why am I not getting data on Google Finance for this product? I'm getting no data? Is there something that it's not open yet because of this move? What are we thinking?
So I see VIX is up 6 points. In theory, this should be down 6%. It's actually only down 4%. That's also, interesting day to do this, right? Is that one of the catches of these is that they're pretty good at, smaller moves, but as moves get more extreme, because of the way they're structuring a lot of these, they don't necessarily correlate perfectly as those moves get more significant.
I gotcha. Okay. So do you know the dynamics of this ETN? Meaning, do they roll like VIX rolls their 28-day volatility, right? They do it on a regular basis. So they're selling front month, buying back month, or second month, I should say, all the time in VIX. Are they doing something similar in VYLD, do you think, or do you know?
Yeah, so like the standard way to be short that 30-day implied or vol number is to have the futures roll on, where you're selling more back month and buying near month to be short because you need to keep that 30-day maturity. So that's one of the benefits in that structure generally in shorting vol, is that not only do you have a VRP premium in theory, you also have that contango premium in theory too. So that's another like tailwind of the short vol trade.
Mm-hmm.
But what's unique about this one is that in addition to maintaining that constant maturity, they're also rebalancing the amount of futures in their position to maintain a position such that X point moves in VIX become Y percent moves or X percent moves in their product.
Okay.
Does that make sense? That like if VIX goes up 6 points, they only want to move 6%, not 22%.
Okay. Got it. Huh. Interesting. Is this optionable? Do you know?
No, I don't believe they listed options on it. And
I mean, well, they probably will at some point.
No, it's not.
It's not? Okay. Would this be something you trade, Jason?
No, I stay away from VIX products pretty much.
Okay. Wow. What a puppy downer you are. And Mark, you like these products, right?
I don't actually trade a lot of them. I think they're, like I said before, they're a good way to get like 1 day directional exposure to something like that. But like, I'm not in the business of predicting 1 day moves in the VIX.
Mm-hmm.
So, I think these tend to be good for like day traders. I think, the cost of holding that over the long term is expensive, and short vols are really difficult trade to manage. So packaging that in an ETN is just all the more difficult in my book.
Yeah. So what's JPMorgan's angle on this? Why do they push this? Especially, probably a safer or a retail person.
Why does anybody sell these things?
Well, I know, but they have to have an audience, right? They have to think there's an audience for this.
Yeah, it's a safer way to be short vol.
That would be my answer, I think, right?
And like people love the idea of being short vol. Like it's why everyone wants to be an option seller. It's why, the short vol trade gets, is attractive to retail and institutional alike. Like there are plenty of, large institutions with huge balance sheet that just want short vol too. So like that idea is attractive. And like, I think there's some diciness in the way it's been implemented in the past. I think the current other examples are better than the XIVs of the world, but like, people want to be short volatility.
Right.
Sexy trade. Like
I don't know. I just wanted to be short premium. I know that's got a volatility component in it, but I really didn't start making good money in the options business when I was a young guy until I learned how to sell premium. And I know, Mark, you come from a little different school, right? From your past life. You guys were probably more premium buyers, I'd say, at your firm.
Yeah, I think the dynamic in markets has changed quite a bit, right? Like I think for decades, there was a persistent vol risk premium and options were expensive. Options were a sale, to the people that could hedge and manage those.
Mm-hmm.
But like that's changed and prices are far more efficient now. And, I think, it's hard to say exactly what dealers tend to have on as a position, but I would say, being short Vega, long Gamma kind of time spread is probably a little bit more of a common position these days.
Yeah. What do you think, Jason, on the from the retail side of things relative to premium? You think most of them are pounding it out, generally trying to gain a little theta harvesting that requires a bell? Are they doing that sort of thing in general? I mean, for me, let me just say one thing real quick. For me, I'm obviously have a pretty keen insight into the retail side because I see a lot of that order flow. It seems like they like to sell premium safely. All of a sudden, think short iron condors, yada yada, right? And I think a lot of the educators and mentors in the space probably teach, those sort of strategies, right? I think. Yeah. Tell me what you're finding.
I mean, I think that's true. I think that when people are first introduced to options, the optionality, the gamma is the most attractive thing. And I see people just, I only know how to long options and then close my position, I think as people get more educated on options, selling premium seems to be the preferred method.
Yep.
Kind of like, I want to jump a little bit on what Mark said. these options are traded pretty efficiently. Like, you can't just say, I'm going to sell premium and you will constantly make money and that you can just set it and forget it all the time. I think that the options now, like variance risk premium, we've noticed has gotten smaller and smaller over time. Like the average variance risk premium, it's still there, but it's not what it used to be. And I think that's because there's more participants shorting options than there used to be. That being said, I do think that, and I also see a lot more collars too, like a lot of, even on ETFs and ETNs. I mean, JPMorgan has a couple of JEPI, JEPY. I mean, they have a couple of call overwriting ETFs that take a SPY position and sell calls on top of it. And I see a lot of that, like ETFs showing up that are kind of like that. And we do it for even some of our clients too.
Sure.
So I do see a lot more dynamic option trading than the typical just buy options or just buy puts to ensure my portfolio.
Sure.
I think that the education and the savviness of the retail investor with options has gone up, even though you will see, what's that, like that bell curve with the dummy dude on the bottom and the smart dude on the top or whatever. And you will get a constant, like, I'm just buying options, I'm buying puts, and I'm buying calls and stuff like that. So, yeah.
So what, in this environment, right? To me, it was kind of telegraphed a little bit, when the new administration came in, we knew this was part of his agenda, their agenda, its agenda, to do this. And, it's like birthing, it seems like to me. There's some pain to get through. But I think, and I could be wrong, at the end of the channel, I think we could get to a happy place with all this. I think. Now,
first analogy of the tariff war to the miracle of life that I've heard.
If you think about it, it's not bad. The more I think about it, it's birthing is nasty, man. I tell you, that hurts. My wife squeezed my hand so goddamn hard on the second one. She didn't have the.
I'd be the first one to say that none of us are qualified to make this assertion.
I was going to refuse myself in this discussion as soon as Lexus.
She squeezed the hell out of my hand
himself right now.
But there's a little pain to get through, is all I'm saying, right? And once you're through the pain, there's great beauty at the end of it. Do you guys feel similarly? Or are you like, this is just a terrible policy, this tariff thing forever? Personally, I hate the fact that, most people don't know this, that every other foreign country charges us a tariff, and we don't. I don't see how that's fair. Am I missing something here? What's going on? What do you guys think? Anything?
All right. So from an economic standpoint, tariffs are always a bad idea. And the reason why is because they are.
Wait. Let me interrupt. Is it a bad idea for the other ones to charge us, to tax us as well?
Yeah.
Okay. Yeah. Okay. Just around the same
tariffs. Well, first of all, the actual tariffs that we are being charged.
Yep.
You can even see on Twitter, a few places I saw that the actual calculation that he had on that board was actually more of a calculation of trade imbalance than it was actual tariffs. So that's the first thing. Tariffs are actually a tax. They are not an imbalance. But that being said, more economic activity yields a better economy, always. And tariffs are they are a mechanism that decreases economic activity. Like we are going to have lower economic activity with other countries. We're going to see a lot of companies now go out of business. I know Amazon got crushed today because a lot of their stuff comes in from China.
Yep.
And I know that the point is to domesticate manufacturing, but that kind of effort does not take a month. That kind of effort takes years and years and years. So I think that so you'd have to get through about 5 years of, as you say, channeling or birthing or whatever. We have to go through a solid 5 years of that. Okay. And before that, though, we're going to see a lot of businesses go out of business and close doors. And I think that, what you're asking is for for the economy to hold up enough in 5 years to increase investment and factory investment and stuff like that.
Mhm.
And I don't if nobody's making money, if there's no economic activity, nobody's going to be building factories. So it's going to be a huge decline, I think, in the economy. I do understand what Trump's trying to do. He's trying to balance the budget without raising taxes. He said it in the State of the Union. He said it yesterday. He said it numerous times, right-sizing government, stuff like that. That's what he's trying to do. And to that end, I agree with him. We need to balance our budget. Public debt is a huge problem right now. And you don't want to wait until, we run out of liquidity to face that. However, tariffs are not the way to do it, I don't think. But I think that there could be kind of like it's not going to be like a straight line down to zero for SPX. It's going to be very choppy. I think there will be some bounces and stuff like that. But
right. And you said, Mark, before you got on this morning, Jason was saying that there are certain levels that you're seeing that we could have a pretty handy bounce here soon by some date was what you were looking at.
So in the April option expiration, we did see a lot of customers buying puts, and a lot of them, probably most of them, are in the money right now. I mean, it goes from 5,700 down to, I think when I checked yesterday, 5,500, and I don't know if more people bought.
Yeah, that's
there's a huge chunk there of puts getting bought, and it was substantial. In May, there's nothing right now. It's a little early to determine that, but in May there's nothing much. So, there will probably come a time in which we will hit a bottom, and I think you said VIX is up 6 points, and the market is down like 3.5, 4,
420.
Yeah, the mark you said is that percent, Mark?
390 now.
390.
So the S&Ps are down 385, 390 thereabouts. Yeah.
So this technically 0.82 times
we're doing
3.9 is so VIX normally should be down 3.19. It should be 5. So this is a vol event technically. My vol event indicator. If we close the day like this, then we should recover all of this within 3 weeks.
Do you want to tell us why that's true? That would seem like a mystery quick calculation. Can you give the viewers a little bit more detail on that one?
Yes.
Without giving away all your secret sauce, for God's sake.
No, this is a study that I've made public.
Okay, go ahead. Let's hear it, because I didn't understand what the hell you just did.
So VIX and SPX have a correlation. It's called the spot vol correlation. Plenty of academic papers written about it.
Yep.
So it has a standard correlation. If VIX deviates from that correlation too much, like usually too high, like in a drop like this, it deviates too high.
Right.
When that happens, usually there's, it's either because of a lack of liquidity, like dealers are demanding more edge because they don't understand, they don't know where the market's going. So they ask for more edge. And we are seeing that right now. Or because a lot of puts are being bought. In both of those cases, primarily with the puts getting bought, you see a lot of support in the market because as you're going down, there's going to be a gamma kind of, dealers have to hedge their gamma and it gets worse and worse. But as soon as somebody buys, they have gamma to unwind. So you can bounce all the way up to where it was. So we did kind of a study. I think when I was done with it, I did a show with you, Lex, long time ago when you were still called like Beer Brewmasters or whatever.
Always around drinking, isn't it? Okay.
But since 2013, this dynamic has happened 19 times.
Yep. And
it has bounced and returned to the prior day's close within 3 weeks, 18 out of 19 times. And it's mainly because of the unwinding of either liquidity comes back, which it eventually does, or puts getting bought underneath, creating more support, and then liquidity coming back, and you get a gamma unwind to the upside.
Sure. Okay. Interesting.
The only time it didn't succeed was in 2015, where it was barely, VIX was over VIXed, which I call it, like 2 points on a Monday, which, you know, is kind of skeptical in the first place. So.
Okay. So in this environment, what I'm seeing, and I'm going to speak not from the pro side, more from the retail side. I think what I see is the retail people doing one of these, put their hands underneath their rear end and do one of these and say, you know, not uncle, but I'm just going to wait this one out. Not everyone, but we see a lot of it. And the only reason I say this is I can see volume numbers and I see them very, you know, granularly. You know, the players who behave in normal markets, let's call it, I'd call this not normal, are not there right now. They're not getting hammered by any means. You know, they're probably losing a little bit, but they aren't trading nearly as much, right? So I think in the retail community, because of their edge dynamic, which means that they give up edge to get in, right? They have to buy somewhere beyond theoretical value, is my guess, or sell below theoretical value to get in. They're finding it difficult, just to what you guys said. You know, we all of a sudden a dealer. I always tell people dealers are really, really smart, and I'm not trying to say that we were really, really smart, but they see supply demand massively on a regular tick by tick basis. And there's no way Mark's going to sit there and sell you the same option at the same price if you keep demanding to buy it. Right. At some point, he's going to move his market and say, you're going to pay higher for this. Right. And then when you buy it at that level, you're going to pay even higher. And at some point, he's going to say, okay, I can't take it anymore. Now I'm really widening my markets out. Right. And when that happens, I think these retail people are like, these markets are widened. I can't get in. I can't get out. They're moving too much. They're creaming my iron condors. I'm just going to watch. So that's what we're seeing a little bit of here, right? You guys have any thoughts on any of that? Similar kind of focus?
Well, see, I was going to say someone's getting in here today, because I don't have like a live OCC ticker, volume count, but I bet you we print 60 million contracts today.
Oh yeah, but I think it's a lot of pro stuff too. I think a lot of pro stuff is, institutional, I should say, kind of activity as well.
And so, like, I think that's where, you were asking about general dealer positions or whatever, that like the way dealers stay in business is by being afloat and being able to provide capital on a day like this, that they want to be long gamma, because if you're sitting in any kind of capital crunch on a day like this, you're not going to be able to take advantage of the best opportunity that you've seen in a year. Yeah. So like the bias is going to always be, keep your hedges in a position that allows you to trade profitably on a day like today.
Right.
Like you never want to be in a position where a down 4% is going to pinch you.
Yeah.
Yes. So needless to say, well, maybe it isn't. Maybe it's not needless to say. Would you like to have, known everything you know about the markets and trading and walked in today with no position? Meaning you have all the capital,
position, right?
Sorry, I interrupted you, but you have all the capital in the world sitting in your bank, and you have no positions and you have this presented to you. Wouldn't that be wonderful? I mean, in my opinion, I'd live for this, in the old days.
Yeah.
Right?
The only thing better would be to have a winning position on.
Correct. Yeah. You have this massive gamma position. You wake up to this and you're like, oh my God, look at that. I'm short 9 million deltas today and it's down 4%. I better cover now. Oops. Right. That's right. I never had that position, by the way. I got lucky once on that. That was called, unfortunately, September 11th, 2001. We were choking on gamma forever, and that happened. But that was a sad day. Despite the money.
That's why you always want to be like, concerned about your gap risk, and why, like, you can look at your Greeks all you want, but like at the end of the day, like you've got to be concerned about a jump move and how much you're going to make if stock's down 4% and vols up, 20%.
Yeah, exactly. Yeah, these days though, I would say on the pro side of the world, because we're buying bid, selling offers all day, and things are widening out. And you do, I'm not saying liquidity. I mean, trading activity dries up 100%. There's still lots of trading. These were killer days for the pros. They just killed it, right? I'd say. I'm talking to some of these retail folks, and they're typically 0 DTE kind of short iron condor kind of folks, and now they can place these iron condors a mile away from at the money, right? But a mile away comes fast in a market like this, and they're still getting breached.
Yeah.
It's amazing. So there's probably a little bit of frustration, with those folks. who trade that way, especially zero DTE. My God, this is nuts for them.
Well, I mean, if they were marching into a Trump tariff announcement with short gamma, then they're getting what they deserve.
That's probably fair. Probably.
I mean, let's be honest.
All right. What else? We got to run here, kids. I'm looking at the, kind of the market's about the same. They tried to take a poke up, but didn't work. Dow's down 3.5%. NASDAQ down almost 4.9. S&P's down, right around 3.9 as well. Technology companies, Amazon and the like, these guys get clobbered because of their global sort of, reach, right? As you said earlier, Jason.
I think Amazon should be getting clobbered because most of their stuff comes in from China, right?
Yeah, I would imagine. Yeah.
Amazon, Apple, both down like 9%, but it's like the banks are actually getting clobbered more. Both like Morgan Stanley and Bank of America are down 10% plus.
Yep. Okay. Interesting. All right, we'll keep an eye on this. We will. I gotta be honest. I'm not trading that much. I'm really not. I haven't been in the game for 2 weeks now, so I don't have much to say other than the fact that my 11-year-old analyst made me a lot of money, and I got out, and it's over, and I'm gonna look to re-up. I'm gonna call him and see what he thinks about this market.
Well, you got a buying opportunity here.
Yeah, I do. I'll be long sooner or later with a safe spread. I'll reveal when I get there. It's coming.
Yeah, I'm just closing shorts today.
Are you?
Yeah.
Wait till you see the size of the butterfly I'm doing to the upside. It's going to be a mixed strike too. I promise.
I can hear your trade hawk dinging away.
Do you hear it? It's dinging, dinging, dinging. Here we go. All right, guys. You guys have a great weekend. Thanks, everybody. Derivative Desperados or Risk Wranglers, let us know.
Yep.
And we will see you next week on the show. That's a wrap. Good night.
You know how the financial world goes. Here comes the buzzkill. Please make sure to take some time to read this boring disclaimer. We will owe you one.